somebody once said it to me in sales: if you have one buyer, you have no buyers. So it really helps to have multiple funds that want to lead, because you then have leverage on the price and you can get a better valuation. You won't get squeezed as a founder.
Hey everyone, this is Prashant and I'll be host for the VC 10X podcast. And today we have Will Sachs with us. Will is a founder and CEO at Falcrum Venture Accelerator, where they are helping mission-driven founders raise their seed rounds. In this episode, we cover everything you need to know about startup fundraising, from how to prepare your pitch deck, how to find your ideal VCs, how to reach out to VCs, how to close your round on the best terms, perspective on Downrounds, and a lot more. If you're a founder looking to fundraise, even in future, this is a must listen. So without wasting any time, let's dive straight in. Hey Will, so good to have you on the VC 10X podcast. How are you doing?
Yeah, hi Prashant. I'm doing great. Thank you. Thanks for having me. It's great to be here.
Yeah, pleasure hosting you. And just to start things off, what's your story and why you started Falcrum Venture Accelerator?
My story. Well, I studied engineering in college and fell in love with creating things. And coming out of college, we created a solar powered race car that we raced from Chicago to Los Angeles across the United States. And this was an incredible experience for me, because it was the first time like seeing something in our minds and then creating it, and having it be real. So after that, I started a lighting company. And then I started a company called Kindara, which is a women's health company that helps women understand their fertility cycles to either get pregnant or avoid pregnancy naturally. And I ran that for 7 years, and we did the whole VC track. So we raised about $9 million, and we sold to another women's health company in 2018. And we made a beautiful piece of hardware, a connected Bluetooth thermometer for women to help them have a seamless experience of tracking their bodies. And again, it was an experience of creating something, from nothing, from seeing a vision in our minds and then making it real. So yeah, I loved both those experiences. And that when I finished Kindara, when I was out of Kindara, I started working with other founders who were in the early stages of creating businesses and products, and really enjoyed it. And so that turned into Fulcrum, where we are now working with cohorts of around 20 founders at a time, helping founders get the seed capital they need to go build whatever it is they're building. And usually these are mission-driven companies that have some sort of positive vision that they want to impart to the world, or some product that they want to bring the world. And we teach them how to raise seed capital, because I found that it's a crucial part of the process, and something that is really misunderstood and underappreciated in terms of how to do it generally.
Absolutely, I totally agree. Fundraising is a big part of like having a venture scale startup, and you need to know how to do it well in order to ensure that your company does well. And and I would like to learn more about your fundraising experience, because I believe this accelerator is kind of built at the back of how you made that fundraise for Kindara, and now all the way through to exit. So it would be interesting to learn how did you navigate the world of fundraising and how you're using that information to help other founders.
Yeah, great question. So in terms of our fundraising at Kindara, we started with a $100,000 friends and family round. And then we did a $350,000 angel round. And then we did like a $650,000 angel round, and then another $700,000 angel round. And then I got tired of raising angel rounds, because the company was always running out of money. Like, as soon as I would raise these rounds, we would hire a couple people, and then 3 or 4 months later, I'd be back out fundraising again. So I never had the time to really focus on executing on the product. And so I just decided, I said, okay, now we need to raise a proper seed round, like a $2 or $3 million seed round. By that point, we had designed and started to sell on pre-orders our connected fertility thermometer. And so we needed a bigger amount of capital to actually deliver that product. And so at that point, I decided, I'm going to stop focusing on angels, and I'm really going to focus on VCs. And so I just started networking my butt off and meeting everybody I could in the world of startups and funding, and getting introductions, and being on the road. I was on the road for weeks and weeks, traveling to New York, going to San Francisco, going to the South Bay, Silicon Valley area, going to Chicago, going back to Colorado. I think I even flew to Korea once when Samsung emailed me and said, "Hey, we want to talk to you." So I went to Seoul and talked to Samsung, which was a really cool experience. Yeah, and just brought the round together. And what I realized through doing that process is that there's a predictable set of steps in every fundraise. And if you follow those steps, you can drastically increase your chances of success. And what I see is that most founders don't even realize that there's a set of steps. And so they're kind of going about it in a haphazard way and hoping for the best and making a lot of mistakes. And the statistics are not in founders' favor. It's something like 1% of startups end up raising VC capital. So if you're going to be part of that 1%, it's not by chance, usually. You have to either learn through the school of hard knocks, like I did, which took a couple of years and a lot of brain and mind dollars, or you find somebody who knows how to do it and ask them to teach you. And that's what we're doing at Fulcrum is we're teaching founders the steps and then actually leading them through the steps so that they can, by the end of being in one of our programs, have raised money and understood the steps to raise money so they can go forward and raise as much money as they want for the rest of their careers as an entrepreneur.
Absolutely. And I see the emphasis that you put on the term steps. So can you kind of give us an overview? What are these steps one by one? And what do they entail at a high level?
For sure. So we teach a 5-step fundraising process at Fulcrum, and this is the process that I used. And the steps we break down into an agricultural or a farming metaphor. So the steps are tilling, planting, watering, harvesting, and closing. And the idea is that everybody wants to raise right now. Like I hear this all the time. People come into our sphere of influence and they say, I need to raise the money next week, or I need to raise the money next month. And typically that doesn't work because you haven't done the preparatory steps to be able to close a round. And so we use an agricultural metaphor because it's the same. If you have a field and you want your corn or your grain tomorrow, well, the only way that's going to happen is if you've prepared the soil, you've planted the seeds, you've watered that corn, and now it's ready for harvest. Otherwise, you're just not going to be able to have any corn or any grain. So the steps are broken down in that way to really drive home that point that it's a process and you can't skip any of these steps. You got to do them one at a time. You can do them quickly, but you can't skip them. And so tilling is about preparing yourself internally for the raise, and that means getting your story straight and doing all the research that you need to do so that you understand your opportunity, you understand it from the investor's standpoint, and you know how to talk about what you're doing in a way that is compelling and clear and concise. So when you get to that point, if you're not at that point, you shouldn't be doing meetings and talking to people because you're not going to get yeses if you're not internally to that point of certainty. And then planting is about preparing your tools for your raise. So that means getting your funnels figured out and getting your pitch deck dialed and getting all the visual stuff that you're going to need to show people and showcase your opportunity in a way that gets them excited. And then watering is about doing meetings. So once you've got the internal certainty and you've got all your materials together, you're into watering, and that's just about doing meetings. And every meeting you do, you learn from that meeting about what went well and what could have gone better. And you'll often get questions as a founder that you don't know the answer to in these meetings. And so every time you get a question that you don't know the answer to, excuse me, you want to go back and make sure you have a good answer to that question next time. And so in watering, it's this process of getting refined and getting tempered by the questions and the comments and the feedback that you're getting in meetings. And the whole point of watering is getting to the point where you have a lead investor, like signing on a lead investor. So that could take a week, it could take a month, it could take 3 months, it could take 6 months, it could take 9 months, it could take longer. Um, and of course, you're working on your business at the same time and keeping momentum going. So then once you have your lead investor signed on, then you move into harvesting. And harvesting is about filling out the rest of your round. And so that's, you're continuing to doing meetings. At this point, you're probably communicating, hey, we've got so and so, they're a great lead that's going to be our lead investor, and we've got half of our round or a third of our round committed already, and we're filling out the rest. And harvesting is really about creating momentum for the raise and some element of FOMO for anybody who's considering investing, because at this point you have a lead and you should have a lot of momentum happening because you've done all these meetings in watering. And then once you've got more people committed to your round, then you have space in your round, then you move into closing. And then it's time to say, okay, the round is fully subscribed. We are now closing. Here's the documents for everybody to sign. Here's the wire instructions to send the money. We're closing on this date. And as a CEO, you've got to rally everybody around the close and actually get it closed. And the harsh reality of this whole process is that the whole thing could fall apart at any moment. Like, there could be some sort of geopolitical event. The lead investor could, anything can happen until the money is in the bank and the docs are signed. So when you're in closing, you really want to get through that phase quickly and get everybody to wire the money so that you can close the round. And then crack some champagne and celebrate. And remember that when you raise money, it's the end of your fundraise, but it's just the beginning of your execution and building a product that is compelling and it's going to get a return for the investors. So those are the 5 steps in broad strokes.
Absolutely, and it's great how you have kind of broken down the entire fundraising process and made it into a science in a way that, okay, this is how you do it in a step by step way. That's great. And
Yeah, it's like, so I'll just say one thing on that.
Mhm.
It's like a recipe for baking a cake.
Yeah,
So if I'm not intuitively good at baking. I don't know if anybody is intuitively good at baking. But when you have a recipe and you follow the recipe, you end up with a nice cake. If you don't have a recipe, you know, chances are that cake is going to look pretty sad.
absolutely. And one more important question that founders often face is, what is the right time to fundraise? And you mentioned this problem in our conversation till now, that okay, I didn't I like founders actually come to raise when they only have runway of maybe 1 or 2 months left, right? So what do you suggest? What's the right time to start fundraising for your startup? And how forward looking should you be when you're raising funds? Like, should you be raising for the next year or maybe 2 to 3 years? And also how it depends on how the ecosystem is behaving.
I think, assuming that you have a fundable startup, that you're working on something scalable that could generate the kind of returns that investors would be expecting, I think you should be as forward looking as possible, because what's the number one thing that kills companies? It's running out of money. That's right. The company's still alive as long as there's money in the bank. The company's still alive, but once there's no money in the bank, the company's dead. So it's either, the only thing that kills companies is the founders give up and or it runs out of money, right? So it's the number one thing that kills companies. And so you do want to look down the track and say, it feels good to have 24 months of runway or 36 months of runway. It means you can execute, you can be frugal with your cash, and you can just keep your heads down and execute on the product, learn how to get customers excited and buying. So fundraising is a massive distraction to actually executing on the business. And so, yeah, I think looking down the track as far as you can and trying to plan it out and not getting into a situation where you've got 3 months of runway and you need to close a round, because that just doesn't feel good for the founder. It adds a bit of desperation into the mix, which everybody can kind of feel at the end of the day. Um,
Yep.
but sometimes you got to do it. I ended up in that situation, but if it can be avoided, it's best to avoid it. So it's best to look and say, hey, if I've got 6 months of runway, I need to be fundraising now. If I've got 9 months of runway, I could be fundraising now. If I've got a year or 18 months, maybe I have a few months to execute. But generally, if you can keep a year or more of runway in the bank, that feels good.
Absolutely. And one more important.
And fundraising can take a lot of time too. It can take, sometimes it can take
Mhm.
6 months or more.
Absolutely. And what one another important aspect of fundraising is the pitch deck. That's the document that gets to your investors before you get to see them face to face, even, right? So, what would be what are the things that an ideal pitch deck should contain, and how concise or informative should a pitch deck really be?
Yeah. So this is a misunderstood area, I would say. So most founders, when they're doing this for the first time, they think that they're going to have one set of slides, and that's going to be the pitch deck, and that they're going to use that in all different. They're going to use that to email to an investor. They're going to use that to present, and that's not the best. That's not the best way to do it. And the reason is because when you email a set of slides to an investor, well, they're going to read them on their computer. You're not going to be there to be able to explain anything. Um, when you are presenting, like maybe you're in your second or third meeting with a VC fund, and they ask you to come in and present, you're going to be presenting some slides, and you want the investor to actually be paying attention to you and not the slides, and not trying to read the slides. So what we teach in Fulcrum is to have at least two versions of your slides, one for emailing to people and one for presenting. And when you're emailing, you've got more words on there, um, and it's much more concise. Like when you're sending a first email and you're including some slides, you don't want to include that much information because you want the investor to be curious and be compelled to ask you to have a conversation or a meeting. So your only goal in emailing slides is to get a next meeting. Um, and so for that pitch deck, which we call an email deck in Fulcrum, your email deck, you want it to be very simple, very clear. You want there to be no ambiguity about what you're building right off the bat. And you just want to give people enough so that they understand what it is, they understand the big picture of why it's exciting, and then they're left with some curiosity to want to dig in a little more and get a meeting. And then
Yep.
when you're actually in person with somebody and presenting, then you want probably a longer presentation, but with almost no words. And so you can speak over these slides that are just illustrating your actual pitch.
Yeah, absolutely, and that's a very interesting insight. I believe that that's definitely one of the mistakes that founders would be making. That having the same set of slides that they're sending over to investors via email, and also using the same one for presenting themselves as well. And there's a good nuance that you should have two separate decks, one for just sending over with the best information possible, which is kind of standalone, right? Doesn't need a person narrating a story with it, and another one where you are presenting. And like once you have your pitch deck prepared, the next and you're ready, let's say you're ready to start pitching investors. At that point, the next goal is to find the right VCs for you, right? Because not all VCs would be the ideal fit, because like fundraising is a hectic practice and it can take a lot of time. So you want to maximize your chances of getting in. Whoever you're pitching to actually has a thesis which kind of fits where your startup is, right? So how does a
100%.
startup find the ideal VC that they should be pitching to?
Well, I would say first pitch a lot of people in your life that aren't investors, so that you can get your pitch. Like you want to make sure that people understand exactly what it is that you're building right away, and you want to make sure that people understand why it's exciting and the big picture potential of what it is. And so I would say pitch a lot of people who aren't on your A list first, to make sure that after they see your presentation, they feel, wow, this is exciting. Like I get it. I love how you presented it. I get the big picture story. Um, and so that would be my first comment. And then in terms of VCs, it's all like the right investors for your opportunity. It's all about alignment. So if you're building an e-commerce company in Canada, you want to find VCs that love e-commerce and want to invest in Canada, or have a track record of investing in Canada. If you're building if you're building a hardware product in Europe, you want to find investors who would be comfortable with that scenario. If you're in India, you're going to want to find investors who invest in India. and are interested in your vertical. So you can usually find that information. It's easily available on the websites of most funds, or you can use Crunchbase or other online resources to make a list. And usually what we counsel is founders to make a list, B list, and a C list. And so your A list is the investors that you'd be most excited to work with. The B list is, one step down, and the C list is one step down. And what I counsel is to start with the B list. And once you've got the B list kind of excited and interested and your pitch is resonating, because it takes a while to get a pitch to the point where it's really dialed, then move to your A list and then move to your C list. And hopefully through doing it that way, you get enough people interested at the same time that there's a little bit of competition. And when you've got competition, that's when rounds get closed. And if there's no competition, it can drag on forever.
Absolutely. Yeah, that's definitely a very amazing insight there. And like, let's say we have our perfect pitch deck ready, our perfect pitch ready, we have found the ideal investors. Now, the next part is starting to reach out to these VCs that we want to fundraise from, right? So, what would be the best way to fundraise? Should founders directly just cold email them, or should they go out looking for warm intros? What's the ideal approach?
Yeah, warm intros are the best. The best possible intro is to be introduced by a CEO or actually by another investor. So probably the best intro is another investor saying, "Hey, you need to talk to Prashant. What he's building is awesome. I just invested." That's the best. Next down from that is like a portfolio CEO. So somebody being like, "Hey, somebody a CEO who's been funded by that investor introducing you to that investor and saying, "Hey, I talked to Prashant. I love what he's building. Check it out." And then it just goes down from there. It's like the more an investor likes, and trusts whoever it is that's introducing you, the better your pre-frame is going to be walking into that meeting. If the investor is like, "Hey, I just met Will, at the grocery store, and he seems like a nice guy. You should talk to him." That's lower on the scale of good intros. So warm intros are best, and the warmer the better. And then if you can't get a warm intro, which you often can't because you just, you can hustle and try and get introduced and do coffee meetings and say, "Hey, who do you know?" Or research portfolio CEOs and see if they'll talk to you and give you an intro. And that's what I recommend everybody do. And that's what makes fundraising so time consuming, is you're just meeting and convincing and enrolling and meeting and enrolling and meeting and enrolling. And then sometimes you just can't get a warm intro. And if you can't at the end of the day get a warm intro, then would I say do a cold outreach. And in cold outreach, you want it to be super brief. You want it to be really personalized, and you want to show where there's alignment. So like I get all kinds of cold outreach emails because people think that Falcrum Venture Accelerator is a fund, or they just, they scrape Crunchbase and they find us and then they email us, which is great for us because we love to meet founders who are raising money. And eventually, we're working on raising a fund. But I get all kinds of like just totally generic cold outreach emails. And I think those don't work in general. Maybe it's just a volume game. You got to send 10,000 of them and you get 10 meetings or something, which maybe those 10 meetings are worth it, but you're also kind of maybe hurting your reputation with everybody else who's getting that email and is just putting it in the trash. Mm-hmm. So a really good cold outreach email is very dialed and personalized. Like, "Hey, Bob, I've been following you for the last 6 months. I saw that you just invested in X company and Y company, and that you have a belief in the future of e-commerce. I read your article that you published in Forbes, and I felt compelled to reach out because I think what we're working on will be of interest to you. We're building XYZ. We have this much traction. This is where we're at. Would love to make a connection and show you more." Something like that is very personalized, right? It shows the person that you know who they are, you've done your research, you think that there's a lot of alignment, and you're giving them a reason to say yes. So that's how to do cold outreach. But I think it's at the bottom of the list in terms of the best way to get in front of an investor.
Yeah, absolutely. And like once you are in there in a meeting, have you identified what are some of the common questions that VCs tend to ask founders, or maybe counters that founders need to have answers to? Like, are there some of these like common questions that VCs mostly use to like dig into the founders
Yeah,
and try to get under the skin, stuff like that?
well, for sure. So as the founder, your goal should be to have a really good answer for every question you could possibly be asked. And you can go on the internet and Google like 300 questions that investors ask founders. There's a list. There's multiple lists of 100 questions, and somebody made a list of 300 questions. So that's a lot, right? If you spend 1 minute on your answer for each of those 300 questions, that's still what, like 5 hours of your time. Um, so you want to have a really good answer for every question. That's the bottom line, because if you don't have a good answer, it means you haven't thought about that yet. And if you haven't thought about it, why haven't you thought about it? Like, it's your job to protect the investor's capital and to shepherd it into creating a return. And to do that, you need to have done your research. Sometimes the answer will be, I don't know the answer to that specific question yet because we haven't launched our product yet, but here's what I do know. Here's the customer interviews we did, and here's what we learned from those. So you want to have an answer to every question, and then at its simplest, what investors want to know is, what are you building? Why is it a big opportunity? And how are you going to be the best at that and keep other people from coming and encroaching on your territory? So you should be able to communicate that quickly. Like with Kindara, I think my opening was, Kindara is a fertility platform, or sorry, a fertility app and a connected Bluetooth thermometer that helps women get pregnant quickly and easily at 1/100th the cost of traditional fertility treatments.
Right.
And so, that's what we're building. And then why is this a big opportunity? I'd say it's a $6 billion market in the United States, and it's growing quickly. And we're going to be the fastest and cheapest option. And then how are we going to win? I would say we have the best user experience, and we're building hardware, which is hard. And so nobody is going to be able to come and do it better than us.
Yeah. That,
And so you want to be able to just
mhm.
communicate it that succinctly. And we see founders, like, it's so painful, Prashant. There's so many founders. They'll talk for like 3 minutes, and then after 3 minutes, the investor will say, "Sorry, I'm confused. I don't know what it is that you're doing." And that's the worst case scenario, because if the investor doesn't understand what it is, then every word that's coming out of your mouth is just a word wasted. There's no excitement. You can't get excited about something if you don't know what it is.
Absolutely.
So
Yeah, I
that's
completely.
important for founders.
Yeah, I completely agree. And another like a big factor in like the fundraise is going to be the kind of valuation you're going to ask for, and then the negotiation process, and then the valuation you're going to eventually get, right? So what do you think is the ideal maybe revenue multiple, or how should founders basically derive at the correct valuation for their startups?
Yeah, well, I would say valuation is not as important as a lot of people think it is, and founders tend to focus on it, and I don't think it's the most important thing. What's the most important thing is, who are you partnering with? Like, who's going to lead the round and maybe take a board seat or take a more active role as the investor? That's much more important than valuation. Like, I would much rather have Sequoia at a lower valuation if I liked the partner, and felt like they were going to be a really good ally, than some very not well known, like, new fund who doesn't have a lot of connections at a higher valuation, because it's just not the most important thing. The valuation needs to go up over time, and it needs to make sense for the deal. Um, and so that's one comment. Another strange thing is that the more money you raise, the higher your valuation will be. So typically in every round, investors want to own between 15 and 30% of the equity. Um, so let's just say 20% as an easy round number. So if you're raising $1 million, your valuation is likely to be around $5 million post money. If you're raising $2 million, your valuation is likely to be like 8 to 10 post money. If you're raising 3, it's likely to be like 10 to 15. If you're raising $500,000, your valuation is likely to be three to four, something like that. So that's a weird thing, that the more money you raise, the higher your valuation is going to be. It's because partially the economics have to work for the investor in terms of how much of the deal they're going to be getting, like how much equity they're going to be getting, and also the simple fact that with more cash in the bank, startups are less risky and therefore more valuable. And so the valuation is probably going to be set by how much money you're raising more than um, by the founder. And then the other thing is, I don't know if you guys have Craigslist in India, but I'm sure you have like these classifieds. Like imagine you're selling, like a dining room table or something.
Right.
If you've only got one buyer, you only got one person who wants to buy that thing, you're probably not going to, you don't have a lot of leverage on the price.
Right. Right.
If they're going to make you an offer and you're going to either have to accept it or not, right? You got no leverage. If you've got three people who want the table, you can stand firm on your price and probably get it. Maybe you can even get them in a bidding war and you can get a higher price than you had thought you could get. And it's the same with valuation. If you only have one fund that is interested in leading your round and is going to set the valuation with you, you don't have any leverage. Somebody once said it to me in sales: if you have one buyer, you have no buyers. So it really helps to have multiple funds that want to lead, because you then have leverage on the price and you can get a better valuation. You won't get squeezed as a founder. And so how do you do that? You got to get those funds interested at the same time, which is challenging. And the way to do that is to run a really tight process around it. Because if you've got one fund interested in November, another fund interested in December, and a third fund interested in January, well, then it's the same as with the table. If you have one person interested in November, one in December, one in January, you still don't have any leverage. You've got to get them all interested at the same time.
Yep.
And that was something that I learned just through experience. And we see that over and over again. VCs tend to categorize deals in their head into like either, hey, this is interesting, or no, I'm going to pass. And when other funds are interested, those deals tend to get categorized as, hey, this is interesting, let's dig in. And so that's why it's like the 1% of deals that VCs are fighting over are because there's multiple funds that are interested, and then the 99% of deals that don't get funded there's just no pressure. They're deals where there's only one buyer at a time. So that's the number one thing. It's a weird reality, but that's how it works.
Absolutely. That's an amazing insight to learn that you need to be able to create that kind of a hype or environment around it, that everyone wants to get in at the same time, right? It has to be that energy. And that's why I believe the founder needs to have that ability, that they need to be good at sales and need to be able to create that urgency that this thing is hot right now. You want it, get it now,
Exactly.
right? Amazing.
Yeah, exactly.
And
yeah, it's like hotcakes. You're like, these are hot.
Yeah.
They're delicious. You're not going to want to wait. You want to get one now. Take two. Take a whole bag.
Absolutely. Yeah. And like looking at the fundraising environment right now, like it's going through kind of like a downturn. So what would be your advice for fundraising in a difficult fundraising environment when there is not as much capital being deployed on as lenient terms as it was before? So what's going to be your tips to navigate this difficult fundraising environment, and also your perspective on down rounds? Should founders take down rounds or not?
Yeah. So we did an event recently on this called How to Raise in an Economic Downturn. So if anybody's interested, you can go on our website and watch that. It's an hour-long conversation that I had with Simon from Relay Ventures and one of our mentors, Dylan Robbins. But essentially, what we're seeing is that valuations are down, that there was probably a little bit of euphoria in the market, and companies were raising big rounds at high valuations, and now that seems to be over. And so there's a lot of companies that have raised at high valuations and are now needing to come to the hard reality that they're not going to be able to raise their next round at a higher valuation. So that's hard because if you do a down round, it's a bad signal. It makes it harder going forward to raise more because you get categorized as a company in distress, and the typical track that all investors are looking for is an ever increasing valuation and an eventual exit. That the company is just executing, getting better, more valuable, and that going to be an exit at an even higher valuation in the future. Once you get off that track and you're now, you went up, you went down, it's just a harder sell for investors to get on board, to keep going. So it's hard for founders if you can avoid doing a down round, uh, and just keep the terms at the same level as your last round. That's, I would say, better. Um,
Yep.
and if you're raising the first capital into your company, you just might have to be okay with a lower valuation. And like I said before, valuation is not the most important thing. The most important thing is getting the money in the bank quickly so you can get back to building the product and getting customers.
Absolutely. And talking about Falcrum Venture Accelerator, so can you like briefly tell us how you help or maybe handhold founders into doing their best at fundraising, basically, and where can founders who are interested can apply to join your accelerator?
Yeah, so the accelerator program that we run came out of my experience of raising myself and then helping other founders raise one on one. And I essentially discovered that founders need to know what to do. So they need to understand the process. They need to have the right psychology so that they're entering into this process with confidence. They need to be able to execute the process. And then they need the right access to investors and to other resources. And so at Fulcrum, we give founders all four of those things. We teach the psychology, we teach the process, we actually help founders move through the process and execute, and then we connect founders with investors when they're ready. So the goal is to give founders everything that they need to succeed at raising a seed round, and then we take a little bit of equity, as part of the process, so that when they succeed, we're building a portfolio of companies that are succeeding and building cool stuff. So that's how it works. Our founders get put into groups, cohorts. So our next cohort is launching on March 23rd. I'm not sure when this show is coming out, but March 23rd, 2023. And then we typically do them every 3 months. So there'll be another one in June, et cetera, et cetera. And each founder is paired with a mentor, and our Fulcrum mentors are successful entrepreneurs who've raised more than $500 million in the market. Um, and we offer founders $1 million in perks. If you get into the program, you get access to all kinds of different perks from different software companies that we've negotiated to make it easier for the founder to execute. And yeah, some of we have an alumni network now of successful founders. And when you get accepted into Fulcrum, you become part of our community. And some of those relationships are now multi-year relationships. And my goal is to build a community of entrepreneurs and mentors and investors who are all helping to create the world that we want to live in. So if anybody is out there raising, you can go to fulcrumventureaccelerator.com and learn more about what we do.
Absolutely. I'll make sure to put that link in the show notes so that our listeners can get there easily. And another interesting aspect about Will, which we haven't covered in this episode since it's more venture focused, is that he's a very interesting personality and that he also has interest in music and creates his own music. So you all should also go and check that out. So I'll try to plug that also in the show notes so that our listeners can go listen and vibe to some of your music as well. Thank you so much for coming on, Will,
Thank you.
and it was a pleasure hosting you.
Yeah, thank you for having me.
Yeah, my pleasure.
Thanks for having me, Prashant. It's been a great conversation.
Thank you.
I hope it's helpful.
Thank you. Yeah, it was. Thank you for coming on.